Hey guys, welcome to the Magnelibra update for the week of April 29th, just one day before May, but you wouldn't know it by the weather here in Chicago as it snowed like the other day, a couple inches. And but we're getting there, so hopefully spring is around the corner. Um, we're going to do an update video this week. We normally write our blog at EconEmotions, which can be found at www.econemotions.com, where we post each week about relative thoughts that we have and anything that goes on in the marketplace that we think is important that you should know. We put in our blog. Last week we talked about money equals value, and whether you're wealthy or poor, money is value, and you can't do anything or much without it. So when we lose money, no matter what, we feel that everybody, disregarding their position of wealth or not so wealthy, it should make an impact or have an impact. So you can go to our blog, and we post weekly, write pretty in depth about the facets of the market that you might not normally pay attention to, such as target 2 balances. And if you don't know what those are, you can go in and read last week's blog, but basically it's a balance of payments in the Eurozone Maastricht Treaty system. What we uncovered last week and what we've been noticing is that the ECB is taking on a negative 250 billion balance, debit balance, which doesn't make sense considering Germany is this big credit balance up here, basically funding the rest of peripheral Europe, with Italy and Spain down here, and Greece most likely going to go back into that area. But it is what it is, and basically the ECB has decided, well, we'll backstop the other national central banks, disregarding any capital requirements or capital ceiling restraints that they may have at borrowing money, and the ECB is going to be on the hook for that. Basically what it is they're funding all this debt, and hopefully these countries will be able to pay it back. That's what Germany's hoping for. So maybe what they couldn't accomplish in World War II through bombs and weapons, and they're going to accomplish monetarily. So we'll see how long this lasts, but we're sure Brexit will have a systemic effect, and there's no doubt that that'll take place sooner rather than later. Especially if you listen to Nigel Farage. He makes for interesting comments always at the EU meetings. And also we talked about last week about the foreign flows out of U.S. stocks hitting about 200 billion. As you can see in this chart, it's had a big increase in 16 to 17, but 17 to 18 to now we're kind of seeing that taken back. We also went into a little bit of the debt for equity swap that the corporations are doing by issuing debt and buying back their stock, which is basically offsetting the foreign investors, pension funds, and mutual funds, who are all net sellers. And just how nicely that matches up the corporate buybacks to the actual sellers. So can't imagine if they outlaw stock buybacks where the equity markets would go. We talked to a couple investors who didn't know before 1982 that these were outlawed due to stock manipulation, and they actually couldn't believe it, how a market would function without stock buybacks. But there's things called dividends. So interesting topic. Nonetheless, but you can see the driver of equity markets not only are the central banks, but are the corporations themselves, as they're going full tilt. Modigliani and Miller, debt for equity swap. If you guys don't know who those guys are, they won a Nobel Prize in economics for basically saying the capital structure doesn't matter how you finance things, whether through equity or debt. But this is in 1970, and the debt levels are way higher now, and as mathematics grows, your numbers grow and exponentiality takes place, and we all know that debt comes with interest as opposed to investment from savings, which doesn't have to be necessarily paid with interest, but rather has a little bit more utility in terms of staying power. Whereas if you can't afford the debt and the interest, you have to pay it back. And if your asset prices fall, well, that makes it pretty difficult. Another thing we touched on was the excess reserves, how they've been basically fallen $1.2 trillion over the last 4 to 5 years, and we really think that this is going to become a problem. We really think the Federal Reserve has got a big issue with this, because what this means is that there's less money in the system here for liquidity for banks that need to borrow against meeting these, not the requirement, but for their own necessities in terms of operation. And what we've been seeing, what we'll get to later here in the video, a little bit of a dollar shortage is causing the ceiling on the interest on excess reserves, which the Federal Reserve tries to use to cap the effective Fed funds rate, is starting to get breached here. And to us, that's basically telling us that there's a dollar shortage. I know the dollar bears out there aren't going to agree with this, but you know what? You can't pay back dollar debt with won, yen, or euros. So we believe there's a massive shortage, and it's starting to show up. But one thing we did point out with this chart here is the fact that we're not seeing excess inflation despite 1.2 trillion in reserves going out into the economy and being put to work, which to us is also telling us that there's massive deflation still going on in the system, and that this buildup of debt is really wreaking havoc on the ability for economies to grow. And we can just look at Japan as a proxy for that. So yeah, this was all last week, so you can guys go back to the blog and read about what we wrote here, and then check out the prior week's lesson on value, which we put a little example over here of somebody purchasing a home in 2001 for 4.1 million, tried to sell it in 2017 for 2.5, obviously a big loss. But what most people don't take into account when purchasing a home is when you have to sell it, and obviously this guy's taking a big loss, but they don't ever talk about the interest paid, which we do. And we actually use a deflator in terms of people would comment and say, hey, well, you know, we would have refinanced it. We did take that into consideration, probably at the optimum times of moving from like in 2001, a 7% mortgage down to a 4% mortgage, and refinancing at the respective levels of in terms of where they were at in terms of payment, and considering a 20% down payment. And the taxes paid. So total loss in this home was 5.6 million. So when we talk about value, yeah, I don't care if you're worth $100 million when you lose 5.6 million. That should bother you a little bit. So when we talk about value, people got to be mindful of what they're actually really looking at in terms. And I think I think that people are rethinking this whole overpaying for stuff in terms of housing, and seeing how much of a drag on their investment plans it may be. You know, a lot of people look at homes as investments, but I beg to differ. Everything I've seen around Chicagoland area, and especially in neighborhoods that might be deemed a little bit more wealthy or upper class, I'm seeing more and more situations like this. So I point them out because I want people to understand that what's going on here. When you have everybody, when you subsidize things, you get overvalued payers, and a lot of times what that does is, yeah, you'll say like, well, that's stupid, that they're stupid for overpaying, but in reality it raises the price for everybody. So which is kind of what we ran into earlier the decade of the mid 2000s. So go back and take a look at these and see what you think. This chart here, the top 1%, obviously 40% of the wealth, and they're going to complain about taxes, which we'll also go into later in the broadcast here, and talk about how they're complaining that they're paying the majority of the taxes. Well, when you make 700 grand and you're paying 100 grand in taxes, I don't think anybody's going to tell you that you're paying too much. So we'll get into that and a little bit more, and a little more into this here, this Chinese debt, which 6 times growth in over a 12-year period. That's crazy. So okay, so let's get into what happened earlier this last Friday. His GDP hit 3.2%, expected 2.5. Let's listen to Rick Santelli here real quick. We love this guy, Chicago homegrown guy. So let's see what he has to say.
2%, a 3 handle on first quarter. It's supposed to be the dog of the year in terms of which quarters excel. This is really powerful. All right, let's go through it. Personal consumption.
So 3.2%, as you can see, estimating at 2.5%. So Trump was gloating about that, but we really know where this came from. It's an inventory overhang, an inventory buildup. So let's just see how far this GDP can rise into the next quarter. We don't think it's going to last, and anybody that knows anything about balance sheets, inventory buildup is not the best thing for the next quarter, because if you don't sell them, guess what that means? Discounts and losses, and production cycles having to be wound down to try to stem the losses a little bit. So even though this grew GDP, we don't expect it to last. So let's see where it goes from here, guys. What else do we have today? Google tumbled. I think they dropped around 6%. Their revenue was 29.4 billion, expecting a little bit over 30 billion. Google Ads only grew in the first quarter at 15%, which compared to last year's 24% growth, that's a 37% reduction. So definitely things are slowing down in the tech space, although Facebook beat revenues, Google here did not. So we'll see what happens to the FANGs here overnight. We do know here that Google is taking a 6% hit in after hours, which shouldn't lead the NASDAQ, should lead it lower, but we'll see what happens. Europe will probably keep this going, but New York is its own animal. And we'll go into a couple more technical charts on the futures, S&P and NASDAQ in a minute. Let's get into, we saw this chart earlier in the week, the dollar-denominated assets less liabilities coming out of China. You can see the last 2 years how we've been talking about this dollar shortage, and you know, we don't know if this has to do with the China U.S. tariff and trade war, but definitely currency related. They're going to have to, they've been selling some U.S. Denominated assets against probably stemming some of the capital flow out of their country and trying to prop up the yuan. So across the board, globally, we do feel the dollar shortage is going on. And despite all the naysayers of limited knowledge of talking about how the dollar is going to collapse, there's too much debt, like we said earlier, you can't pay back U.S. dollar debt in yuan. And there's a lot of U.S. debt out there, so we look at those as major short positions. So in order to alleviate the short position, you got to acquire dollars, and there's just not enough of them to go around, and the Federal Reserve makes sure of that. You know, having a shortage and a control on production of your product and leads to a very good prospect of keeping your product in well demand. Moving along, we'll take a look at the VIX positioning. We saw this chart earlier today as well. You can see that net VIX positions are at all-time record lows. You can see what happens after we get to these points. You get big spikes. We expect a big spike here. We don't know what will be the cause. Maybe it's Brexit. Maybe it's the Fed saying, you know what, we're not going to cut rates anytime soon. We're going to let the balance sheet run off a little more, even though we know they can't. But one thing's for certain here, that this complacency can't go on forever. But the VIX selling and VIX smashing and S&P rising, you know, that's kind of where we have been, and it's where we continue to be, and it didn't make sense and doesn't make sense to fight until things change. So until this changes, we don't see any reason why it won't continue to even get even more complacent. But as we show in the next few charts, you're going to see kind of things are starting to turn around. So when we look at the S&P 500, almost near all-time highs at 2961. We're probably not going to hit that considering Google's numbers late today. Our big line in the sand is 2901 here in the June future. If we start to trade down to that level, we probably see some people step in to get long, but we don't expect that level to hold. Not considering where we're coming from, it would make sense if we do start to pull back that we pull back from this double top level. And when we look at the NASDAQ versus the S&P, which is something Magnelibra likes to do, since we're long short, we trade pairs. One index versus the other, and you can see here the clear outperformance. This is the NASDAQ versus the S&P 500, and you can see since February the complete outperformance of the NASDAQ index versus the S&P 500. Although it broke up out of this trend channel, and we've gotten back in there fairly quickly, and the NASDAQ is now underperforming the S&P 500. Which is, since it's leading the way up and now it's turned around, but the S&P hasn't followed suit, something's definitely changed here in terms of market structure. So I don't know if these insiders are getting out, if a little risk is being taken off the table. Maybe it's FOMC related. So maybe we can figure out that the top might be in here. They're trying to take some risk off in the NASDAQ, and they're moving back lower here against the S&P 500. So the NASDAQ is starting to lead the way down here now, back into this trend channel. We also followed against the Russell 2000 index on a 2 times Russell versus NASDAQ. You can see here in early 2019, the Russell was outperforming on the way up, and you can see since late to mid-Feb that it's gotten took a drubbing here. And the Russell, the small caps have led the way down. Actually broke out of the little trend channel here for a little bit, but right back into it. And now, as once again, the Nasdaq is starting to lead on the way coming back down, and now the Russell's starting to outperform. So with the Nasdaq breaking back into these channels after its outperformance, Google's numbers today, pretty confident here that the market structure is starting to turn around, that the shorts might be in control here. But obviously, this could change, and we'll see how the reaction to Google is in New York session to see if some bottom pickers come in, which we would probably guess they will, but we're not so sure that that will hold, because if they start to hit the other stocks, Amazon, Facebook, and Netflix, then pretty safe bet here that the S&P and the Russell will probably turn down with them, although the Nasdaq will lead the way down, as it does lead on the way up here. Talking about Netflix, we can look at the total debt here in Netflix, up to 10 billion. Q4 2018, Q1 2019, and we think Netflix got a real big problem here. Hulu is on their heels, gaining subscriber base. Disney is going to start streaming as well. So I think the big boys here, like Disney, are basically drawing a line in the sand and going to take some of Netflix thunder here. We're not really sure if Netflix can survive given this debt structure and given the fact that they spend around they've spent 12 billion in content in 2018, as Variety magazine pointed out here, and 15 billion this year. So they are paying up for content, but how long will they be able to do that, and how high can their debt go? And considering the fickleness of the Gen Z and millennials, we know that if their monthly subscription price goes too high, that they're going to lose subscribers. In terms of their R&D expense, they're up to about 370 per quarter, which is 1.2 billion a year. So add that to their debt, add that to their content purchasing. They have to make money, or start to make money, at least in terms of all the money that they're putting into this stuff. Their investors are going to start to demanding a little bit more. So it'll be interesting to see how this plays out. For now, I'm not a big fan of Netflix. Here we were talking about earlier about the interest on excess reserves, which is what the Federal Reserve used to cap the Fed funds rate. But the effective Fed funds rate is starting to trade above there. Now, JP Morgan put a piece out this week outlining this, and we talked about it last week. And for us, we believe this is a dollar shortage situation. Talked to an investor earlier this week. They were questioning, like, why wouldn't they just use the discount window? And we agreed. Like, yeah, they could use the discount window, but the only problem with that is now you're going to make it public knowledge. And when you use the discount window, that equals stress. That means you're under some sort of liquidity crunch, and once your name's out there, well, then your bonds might get hit and your equity might get hit, depending on who you are, and thus we're talking daisy chain effect of circumstances that may transpire that would adversely hit everybody. So you're going to hide it as long as possible, but we're starting to see it here in the effective Fed funds rate trading above the IOER, which we can't figure out why they still pay IOER, but we kind of figured that the 2.5% was kind of the limit, considering the 10-year yields are sitting right there. And one of the indicators that we like to watch is the Fed funds 10-year, in terms of putting a lot of leverage, interest rate stress on levered players as short-term funds start to hit their bottom lines. So we kind of knew that the Fed wouldn't be able to push it too much further, but we didn't expect them to do it about face as quickly as they did Q4 of 2018 to now, where they're actually talking about cutting rates. But we like to watch that 10-year. If that 10-year starts to stay below 250, moves into the 240s. I think it got as low as 229 earlier this year. You could bet the Fed's going to have to cut rates. So even the Fed's not bigger than the bond market. So if stresses start to come, we're going to see it. We're going to see it here. We'll see it in the short-term rates, and we'll see it in a steeper yield curve, which we already have started to see in Q1 2019. We also saw this chart today from Patrick Bourbon, a Chicago guy that we follow here in the investment community. I thought this was a great infographic, one I haven't seen before, but I do like the data that it presents and the visualization it presents. Basically, he's talking about stocks lose on average 39% per decade, and we have not seen it this decade. The max drawdown is 13%, as you can see here. We're probably going to, hear stories that this is a new paradigm, central banks are in control, yada, 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 just like we've heard all throughout these decades, but no, nothing's changed. In fact, we're exponentially worse here. We're highly levered now. I think anything can trigger this. Brexit could trigger a fallback. Obviously, a geopolitical event could trigger it. But we're not out of the woods here by any means. And no, we don't think it's a new paradigm. We just think the central banks have just poured more fuel on the fire. It's not just the Federal Reserve; it's globally. So, they keep using the same solution: print more money to stop any liquidity. But eventually, it's going to fail. So no, we're not in a new paradigm. And but will we break this decade? Who knows? Might wait till after the election next year. We point this chart out to a lot of investors all the time too, that the central banks basically print money, and that's how we continue to the asset price appreciation. So you can see the slowdown in the monetary printing, but you can also see the slowdown in the S&P 500 too, and that's why people clamor about debt and say, "Oh, all this debt, we can't raise our debt levels. U.S. has to have a ceiling." No, they really don't. In fact, if you want GDP growth, you need debt to be printed, and people don't understand that money is debt and debt is money, and they're the two sides of the same coin. So without it, we can't get growth. Without it, asset prices collapse. So I don't know why they keep playing that game. I don't know if I guarantee Congress doesn't understand it, but the astute investors should understand by now our monetary modern mechanics and how debt functions as our asset price backer. But the problem we are having is that too many people don't have access to this capital and aren't really benefiting from this asset price growth because it's being concentrated in a very few hands. I mean, who really owns stocks? The top 20%. And even more granular is the top 1% that benefit from all this. So what you have is a major income disparity and a two-tier economy, one where a very few benefit while the others basically don't play the game at all. So that's what kind of the situation that we're in. And so we'll see what the Fed does this week. They've got a meeting. It's widely expected they don't do anything. The rhetoric might not even be much of anything. They might just be buying time till June and see where Q2 ends up. So it's funny that we see this headline out today. The Fed's looking at a new program that could be another version of QE. Basically, this is all they do. They look for ways to hide illiquidity as much as they can and keep the money concentrated in a very few hands, which is what they've done. And this is nothing more than their plan of what we've called for a decade of QE forever. And that's what they do. And I've hashtagged this for over a decade, and I still believe it's the case, and there's no way around it. The fact that we can only raise Fed funds at 2.5% should be quite obvious to everyone that Japan is our proxy. And when we talk about income inequality, you can see this chart from Statista. Basically here's your top 20. They have 51.5% of the share of household income. It's gone up from 43 to 51.5 since 1970, where everyone else is, lower from where they prior were. So this is what QE does. This is the reality, but this is the system that we have. And until we change this central banking global system, this will continue because it's the only way they know. Fighting the same fight with the same weapon, and it works for them. Obviously, when people say the Fed are they successful? Well, it depends on what your position is. Yeah, if I'm in the top 20%, yeah, they're successful. So that's what we're dealing with, and then we'll get the guys talking about tax changes and how the wealthy pay an exorbitant amount share of their taxes, which we have this chart here. If you're in the top 1%, your income is greater than $718,000, and your share of total federal taxes paid is 27%. That would seem high, but when you look at the share of pre-tax income, it's 16%. So you're netting 600K. I don't think anybody is gonna complain about netting 600K after tax. Obviously, as you get this way and you go this way, yeah, you pay less taxes. Your share becomes less, but the real economy is here. It's not here. you know, you make 112,000, you're paying 37% of your share of pre-tax income. That's a big hit. You know, you're talking about over $30,000. So, you know, when we talk about reality, and you know, when we talk just nominally in terms as opposed to percentages, yeah, I'd like to take 600K net and give up, you know, 27%. You know, so let's look at it realistically. You know, you're making 6 times the 81st percentile. So you can survive. You don't have to sell your stock to survive. You don't have to sell your stock or sell your home or sell any of it to survive. You're insulated, and that's why we have such a major disparity. So, so there's no argument for this. They're not paying a greater share of their income. That's, you know, in terms of nominal take-home pay. You know, there's no argument there. You're making 6, 7 times as much as the top 20%. So nobody's going to feel bad for you. So that's it. Hope you enjoyed it. For now, we'll end it on a Kenny Powers boom, and we'll hope that you enjoyed and learned something today, and we'll see you guys later. We're out.